Welcome back to Tradiers, the Trader's Edge podcast. I'm Jim Urio. That over there in the other box is Bob Iacchino. How are you, Bobby?
First of all, it happened again where we're in the middle. I'm about to say something to you and we get cut off by the countdown.
We will understand this technology at some point in time.
No, we won't.
Yeah, no, we won't. No, because we don't give a shit.
No,
Is what the answer to it is.
Real quick, Jimmy, before we go to someone much smarter than us, what do you think of the sort of juxtaposition of the GPI today on the beige book, which kind of told opposite stories?
You mean the GDP today?
What did I say?
GPI.
No, that's a kind of an engine that you put in a Dodge Challenger. I meant GDP.
GDP. Okay, I'm starting to not really believe some of our headline numbers. I don't know why, and I'm not pointing a finger suggesting that there's any sort of malfeasance. Well, I mean, I am in the back of my head, but I'm not saying that out loud.
You're just not literally pointing the finger.
I'm not literally pointing my finger. See, my fingers aren't pointed. So some of these numbers we've seen lately, I have a lot of questions about because there's so many other very, very conflicting data points that I'm seeing that to me suggest that things. And I don't like having been that guy for years saying, no, the recession's coming up in 3 months, but I am still that guy who said the recession's coming up in 3 months. One of your points that I like was that you said you thought this Christmas season, this holiday season would be very good. A lot of contract negotiations with unions made people feel quite wealthy. A lot of people they have this YOLO attitude, like live for today. And I think once we've been through what we've been through over the last 3 years, I can't blame that for a lot of people. So I think people are spending themselves, and I think there's going to be a problem. What do you think?
Yeah, I agree. The only thing I will say, and again, we have a guest that's much smarter on these subjects than us, is I'll say I think GDP was an outlier, and we've seen outliers before. I mean, if you go back and look at U.S. GDP, outliers happen all the time, whether it's base effects, whether it's, you know what, the CHIPS Act, for example, a lot of that money went into the private sector. And when you give money to the private sector, they spend it, which is good. So that could be part of it as well. But again, we have someone smarter than us on.
Exactly. Again, and one thing I've always said about our shows, both of our shows, is you can think that Bobby and I are full of bullshit, and which is fine because I think that half the time anyway. But you can't deny that we get really good guests. And we have a really good guest again today. And I'm going to butcher his last name, and then you're going to correct me. This is how it's going to play. It's Marko Bjegovic, who I've known for a long time on Twitter, but I've never had the occasion to say his name out loud. All our correspondence has been writing. He's the founder and CEO of Arkomina Research. He's a bright guy. Let's bring him in and let's break him down and see if we can get him to say what he really feels. Marko, good to see you.
No matter what metric we go by, Marko, my head should be higher than Jim's in that intro.
Not a chance.
Whether it's alphabetical by first name, alphabetical by last name, height.
Nope. Level of importance, or at least who thinks they're the most important person on the planet, and that has to be me.
Right? I feel like you guys are trying to keep my head small by putting me low. It's not going to work. My wife's been trying it for years.
Trying to keep you and I humble. That ship has sailed a long time ago. Marko, let's go over the ground rules. Like, you have a lot of things you want to talk about. We're going to ask some questions. Yeah. If you think we're going down the wrong path and there's something more important to talk about, tell us to shut up and tell us what we should be asking. Absolutely. As you probably can guess, it is a relatively informal setting, but we do want to go deep into some of the stuff. And I think the stuff you've put out over the years, I think has been great. And I first wanted to say that I appreciate that a crap ton. Everything I read of yours on Twitter, I like your analysis. I think it's very straightforward and easy to read, which a lot of other economists try to make things so bullshit complicated to make themselves sound smart. The good ones put it in plain language. You do that. But did you hear Bobby and I talking about today's GDP number? First of all, what do you think of that?
Yeah. Well, actually, I agree with you. Actually, this is an outlier. It's a third quarter. Whether it's 5.2 or 4.9, actually, it makes little difference because I don't know, both numbers are pretty high, and I think I mentioned that on Twitter that actually I want all the people to remember this number because we are probably not going to get something like that for some time. So actually, this is like something that is more like an outlier than like a trend or something. and probably in the fourth quarter we are looking into something like 1 to 2%. We still don't know what it might be like, because it's still early actually. We are still in November. Maybe, well, some people think that we are already 2 months into quarter, which is true. But in terms of the data, we are only beginning to see the October numbers. Actually, we haven't seen all of the October numbers yet. So actually, we are just like we are not even 1/3 into the quarter. We will be at some point. But when we get the first the advanced estimate for the fourth quarter GDP in January, maybe things will change. We don't know at this point whether consumption will keep rising, but at slower pace, or maybe we actually see some I don't know, maybe some decline there or something. At this point, this is unclear. But from what we've seen so far, actually sales for Black Friday and Cyber Monday have been strong, and probably if we are going to base our estimates based on these numbers, actually we may think that this holiday season may be somewhat stronger, or probably stronger than last year, because last year was like, I don't know, it was the weakest in some years. And actually, but what happened last year? It was that consumers actually deferred their consumption due to high prices, because they anticipated discounts in January. So actually, what we got was that consumption didn't rise as much in December, but then it went through the roof in January, and this was the lag effect. This is not something that usually happens during this time, but due to high prices, actually consumers acted that way. I don't think they will act that way this time, because so far we've seen a lot of price discounts. For example, if we look at the Adobe Analytics, they noted that since mid-November, actually prices were down. I mean, they really noted some strong deflation in prices, and actually they're estimating that there may be a total of, I think it was an average of 35% decline in prices, which is like, I don't know, the largest on record. It hasn't happened yet, like in this period. So actually, if we see such decline, it may be stimulated for consumption in December. So actually, we may see some higher numbers in December. So a lot of things depend on the consumer, whether this holiday season would actually really live up to these expectations. For example, Bloomberg expects, I think it was 4.9 or something percent up consumption during this holiday season. For example, last year it was, I think, 3.5 or something. So actually, this year should be a bit better, but it shouldn't be like what we had in 2019, like prior to 2020 lockdowns and all the stuff. When it actually rose double digits, it was like, I don't know, 13-14%. I'm not sure exactly, but it was in that neighborhood. So actually, we are probably going to see some stronger consumption in December, but it may not be as strong as it was prior to 2020. and we may not see as large lagged effect in January like we saw this year.
Okay, so that's my question, Marko, and this is something you might have heard in the intro that Jimmy and I talked about this before. My prediction was that the holiday season was going to be strong, and I take that in part because of the wage growth that's happened over, say, the last quarter and a half. You know, you look at this was a record year for strikes. Well, not record, but it was more than 2018 and 2019 combined. We had more workers go on strike, and most of those strikes were successful on some level. Also, you take the real wage growth because of the moderation in inflation, the increase in wages. I thought people were just going to party. They were just going to go crazy and buy gifts and not worry about it and buy food and buy dinners. They're still complaining on social media, but I'll throw an anecdotal piece of data at you. And we all know anecdotal is it's shitty data, right? But this particular cyber, well, it's just my anecdote. It's not anyone else's. Yeah. So it's not a large data set, but this particular Cyber Monday, we were sitting on the couch, and all year I heard my wife say, God, I want to buy this, but the price is just crazy. You know, we really need this, but I should have bought it last year. The prices are just crazy. Cyber Monday on the couch while I was watching a terrible Chicago Bears game, my wife was like this.
Yeah.
Buy Cyber Monday, right?
Yeah.
Basically because there were now discounts. So if I extrapolated that, which is irresponsible to do, but if I extrapolated that and said, a holiday season with the discounts, and as we all three know, sometimes those Cyber Monday and Black Friday discounts extend a week, 2 weeks, all the way into the actual holiday now. Do you think there might be a hangover in January and February from all this pent-up purchasing that happened over the holiday?
Definitely, because if you see, actually, most of these purchases are bought using some kind of buy now, pay later option. So actually, these options were, I think it was like they were up by 75% compared to last year. This is like a huge jump. Actually, you would want to see. I mean, you would expect to see some kind of a hangover in January or February because of that activity. So yeah.
Historically large or typical?
I would say more than normal.
Okay.
Yeah.
Okay. So Marko, Bill Ackman says cuts coming in Q1. Jim Bianco says no. Generally speaking, I go with Jim Bianco over most anyone else because I think he's brilliant. But I kind of go with Bill Ackman too. Based on a couple of your answers, there's been a couple times I thought you were in the same camp as me. Recession eases coming relatively quickly, but then a couple times it didn't sound like that. Can you put a fine point on that? Do you think cuts in Q1, Q2? Do you think recession?
I'm going to read you guys a tweet on this in a minute. Go ahead, Marko.
Yeah, definitely. Because, okay, so maybe I can talk about this for hours. Actually, what's really going on? I think that you're of a similar opinion. The Fed has actually gone too far. Like they should have stopped hiking a long time ago.
That is absolutely Jim's opinion, by the way.
Yeah. They did not do that because we still don't have some effects that would suggest they need to cut, etc. Yeah, but we do not have these effects because they are lagged. Because you need so much time for every cut to be absorbed by the economy, and you need a lot of time to see.
You mean hike? You mean hike, not cut, right?
Hike. Yeah. Cut and hike. Yeah, it's the same. But
same shit, right?
Yeah. So actually, any policy change, you need quite some time to see it in the economy. If they are looking only at the current data, like CPI, they are actually looking at something that happened like more than a year ago. CPI is still noting what happened with rents in the first half of 2022 when rents were like rampant. and it is still plagued by these numbers. On the other hand, rents are actually deflating at the moment. If you look at, for example, apartment place national rent index, you will actually see that rents in November were -1% month over month. So actually, this is quite a lot. If you look at the shelter, you will see 0.3% upside in, this was in October, but probably in November it wouldn't change much. So actually, while you're having real rents declining, you're at the same time having shelter component, which is actually still noting positive month-over-month changes, and this difference can be quite a lot. For example, in October, it was, I think, shelter was plus 0.3, and apartment place national rent index, it was I think minus 0.7. So actually, you have 1 percentage point difference. This is like a huge difference, because it goes to shelter. Shelter is a component that makes 34% of the headline and 43% of the core CPI. This is like huge, to the point that actually in some months like September, all the inflation number that was actually registered by the CPI came from the shelter component. For example, if the shelter component was zero, just zero, not negative, just zero in September, headline CPI would be minus 0.04 or something, and this way it was 0.4, like plus 0.4. This is like a huge difference. People think, okay, yeah, headline is still rising. Obviously not anymore because of the gasoline prices. But in September, people thought, yeah, this was like inflation is still a problem. It is still going up. Yes, but if you look at real rent inflation, then things change dramatically. Like you're not looking at this like, I don't know, 0.3, 0.4% month over month, but you're looking at much lower numbers. And if we would like take out this shelter component, and then we would replace it with something like apartment place, you would get to year over year inflation of only like, I don't know, 1% currently. So it's not like 3.5 or 3.2% that's noted by the CPI, but it's much lower. So if we are in this situation, this means that after some time, shelter will start noting more what happened with rent inflation in the second half of 2022, and back then it was also showing negative numbers in September, October, November, December. This is like seasonal move during the year, and many people don't understand this, but CPI is actually on year-over-year basis. It is calculated using non-seasonally adjusted data, and on the month-over-month basis, it is calculated using seasonally adjusted data. So since the Fed is only looking at year-over-year numbers, actually, then non-seasonally adjusted data is more important than the seasonally adjusted data. And the seasonally adjusted data, it gets like revised. The seasonal adjustments get revised every time in February. they did it prior to 2023. This year they were doing it every 2 years, and now they will do it every year for the prior 5 years, meaning that these, for example, 2023 numbers will be revised each year going forward until 2028. So by 2028, who knows? Yeah, who knows what we'll have? Like maybe it will be 0.3 per month, maybe it will be 0.1 per month, maybe it will be minus 0.1 per month. We don't know, because they can just adjust these seasonal adjustments. So actually, from what I'm trying to say is that it's better to look at non-seasonally adjusted data, because this data will not get revised. Like this is it. What they published, it's as is. So actually, year-over-year numbers wouldn't change, but month-to-month numbers could change. For example, in February 2024, and then February 2025, etc. But of course, when we go to 2026, no one would still care about 2023 inflation numbers, because at that point something totally different would be in our focus. So this
all right.
is
So I'm actually
going
to read one of your tweets here. Before I do, I want people to follow you, because it's M Bjegovic, which is MBJEGOVIC. That's Twitter. That's his Twitter handle. So at MBJEGOVIC. And the only reason I could spell this because I got it right in front of me. But I want to read, one of the great things about your Twitter, Marko, is you take people on constantly. Some people might even say that you're poking them a little bit, right? And I actually like that, because what a lot of people don't understand is Eastern Europeans, they just speak the truth. It's not like you don't dance around subjects. And the Kobiesi letter the other day put up, the Fed's job is only half done right now, or potentially even less. Inflation is still above their 2% target. If they move too soon, they risk a resurgent. If they wait too long, recession will hit. Expect volatility. And your response was, and this is how I knew you were on the exact same page as Jimmy on this. Your response was, this is not true. Excess inflation was pretty much dead in late spring 2022. You read that right, before the Fed even started doing 75 basis point hikes. They made so many unnecessary hikes that are extremely damaging to the economy. If left over time, they should actually cut hard, not search for proof to do more. So Jimmy's been saying that for a long time too. He didn't specifically say before the 75s, but Jimmy has been adamant about saying they're going to go too far. Jimmy, I think you started saying that after the first hike. Go ahead.
Right.
Jimmy.
Well, what I was saying too is that they hiked too fast. Everybody held on to assets like grim death, particularly in the housing market. You see that because nobody wants to part with their loans. Everybody had ample time to roll into duration. I think we always lagged in variable efficacy for these rate hikes. I think it's more lagged than normal, and I think that it's going to hit all of a sudden like a punch at the wrong time. And I think all the drop we've seen in inflation so far is due to supply chains healing. I don't think that's, what do you think, Marko?
So wait, let me finish with the part of the
Sorry.
question I wanted to ask you, if I could. What do you say to somebody that says, yes, goods inflation is falling, whether it's due to the Fed or not, but services inflation, based on my math, and actually it's Mike at Invictus's math, not mine, but on a 3-month annualized basis is still running at about 5.2% on the services side. That's current, right? Obviously. So you say the Fed should cut hard. What risk in your mind is there of a reflationary scenario that would scare the consumer out of spending more? Just like I agree with you that they were scared out of spending.
Well, actually, I don't think there are much risks about inflation picking up again, because this is something that people are only concentrated on the rates, like whether the Fed is hiking or cutting. But if they are going to cut from here, that doesn't mean that they need to stop doing QT. This is like they have like two tools. They have, one is rates, the other one is their balance sheet. And if the balance sheet keeps contracting, I don't think we are in for another inflationary episode. Well, of course, it can always happen because the government is doing something. For example,
Of course.
if they lock everything down again, or I don't know, if I don't know, some war breaks out or something, we could again see some problems on the supply side. But this doesn't mean that it needs to be like what we had in 2020, because in 2020 actually they expanded their balance sheet. They doubled their balance sheet in like a matter of months. It was like a really unprecedented QE at the time, and it took so much. I mean, so long for them to like come back into territory which is not expensive anymore. They got it. They got to that territory sometime. I think it was in March this year, and after that they are actually in like balance sheet. Currently, it's not too restrictive, nor it is too expensive. It's like more somewhat balanced at this point. But as they are doing more QT going forward, they actually risk maintaining this level of QT for too long, and then maybe breaking something and so on. But we are likely not at that point at this time. We may come to that, but not yet. Let's say it like that. So when we have the Fed cutting rates, it doesn't mean that inflation will magically just reappear because they are cutting rates. Many people think that inflation came because rates were zero. If that was true, then we would see we would have some I don't know, rampant inflation in 2011, 2012, 2013, and all these years, but it never happened. Actually, rates were quite low, aside from few years like 2017, 18, when they were hiking a bit. Actually, we were in the same zero bound environment that we were during 2020, 2021. So this wasn't like there wasn't much difference between these two periods. So actually, what is that got this inflation in 2020 and 2021? It was something that didn't happen during the 2010s, and this is something that Jim has been pointing out. This is helicopter money, of course, because government was like handing out money to everyone. People were just they were at home, sitting on their hands, doing nothing. They were giving money each week. They didn't know what to do with that, and they just started spending because this was like something that I don't know that kept their mind busy or something. And then when they started to ease these lockdowns, of course, then people were like, okay, finally, I can now travel, I can now do whatever, I can now socialize, I can now do every little thing that I was denied to do for 2 years, and then I'm like, I don't know, people were like dogs out of the leash. So actually, this was like this was what got this spending and what got this inflation running so high at during 2021 and first half of 2022. And then inflation got to 9%, over 9%, according to the headline CPI. And then all of a sudden, inflation just went down. Like it was
Marko,
beginning of June.
Let me stop you real quick, because about that point, when you said inflation went down, it seems to me that inflation started to go down because the supply chains healed. With the nod, you agree with that, and high prices are somewhat of a cure for high prices themselves. But so now that we look at what this is looking forward going into the next year, my base case is this, and I'm curious if you agree or disagree. I think the first thing the Fed will do is they will stop QT in some way, because I think they're probably a little freaked out at the fact that the last 3 duration auctions went poorly and were kind of sloppy, and they realize that that's maybe where they have to bolster the government's profligate spending. That's one of the reasons that all year I've been long gold, long Bitcoin. I think assets like that are dollar hedges, when the market starts to think the wheels are coming off, those are the assets that are going to do well. And stocks might do well too, and that's fine. I just think those other things are going to outperform. Already, Bitcoin and gold, the calls are trading with a skew to the puts, meaning the market is starting to agree with me that disaster exists to the upside. Is your base case too that the first thing they'll do is stop QT and, heaven forbid, start QE?
Well, I would just hope not.
Yeah, me too.
Because
for my positioning.
This is like the worst thing that they can do at this point. I think it's more about rates than the balance sheet. If you just look at it, they said that they were doing 95 billion of QT per month, which is 60 billion of treasuries and 35 of MBS. But actually, they never got to 35 of MBS. They have been doing, like, I don't know, 17 or something average per month, which is like they never went to their target that they.
Oh, so they're not letting as many roll off as they said they were going to. That's
interesting.
Interesting. I didn't know that.
They are not doing that, and this is one of the reasons why actually housing market has been somewhat more stronger. Let's say like that, stronger than it otherwise would have been.
Yeah, it hasn't collapsed, right? Housing market has not collapsed. I mean, it's not great, but it's certainly stronger than people would have thought, with close to 500 basis points of tightening.
Yeah, actually, yes. Well, there are 2 things here. Actually, one is of course, housing market is driven by rates. Rates have gone up, and when rates have gone up to 7% and 8%, where they were in October, actually people don't have any incentive to sell their house, because they say, okay, we got our house at 3%, or maybe sub 3% or 4%, doesn't matter. Still 8% is like way up from where they got their mortgages, and they are not willing to sell their house unless they really need to. So actually, there are not many economic reasons for them to sell their house, and this is putting a constant restraint on supply in the housing market. And at the same time, of course, demand has collapsed as well, because we have demand that still near multi-decade lows since 1995. Actually, demand is now much lower than it was during the great financial crisis. This is what some people maybe don't know, but actually,
wait a minute.
Demand
can I
is really
clarify that? Housing demand is lower than during the financial crisis right now? Well, I didn't know that.
Mortgage demand. Mortgage demand. Yeah.
I did not know that.
Yeah.
It's just a supply issue then. There's not enough supply in the housing market. So and that's the rapidity of the Fed rate hikes. All they ended up doing was make people hold on to their mortgages like grim death and not enter their house onto the market. Well, that's interesting.
What I wanted to say is that demand has collapsed, but supply has collapsed even more. And this is what is driving the prices. Actually, when you look at the prices of houses, you can see that they're off of their peaks. For example, for existing homes, they're at -5, I think, percent from their peak during mid last year. And for new homes, prices are actually much lower. They are -17.6% from October last year. This is the largest year-over-year decline ever. Like on record, the record is since 1963. So actually, it's quite a lot of years here. So this is like. On one hand, you have 17.6% year-over-year decline in new home sales, and on the other hand, you have only 5% decline from the peak in existence in existing homes. So actually, what is driving that? Both of them are of course plagued by high rates, but
can I stop? Can I ask you a quick question? Do you believe there's a structural supply shortage that stems back from the financial crisis, or is the supply shortage only because of the rates?
I think it's only because of the rates. Because if rates were only like, I don't know, 5% or something like that, you would see the market
rolling,
like
right.
turning, rolling. Yeah. So this is like, I don't know, 8% seems too much, and if they could bring it lower, because when you see at new homes, actually people are getting mortgage rates of, I don't know, 4.5-5% because of mortgage buy downs that builders are offering. So actually, these buy downs are only valid for the first, I don't know, 3 years or something. But it can be enough to lure in the buyers and to start the market. And on the other side, in the existing homes market, you actually have this, I don't know, stagnant market where people are not really, I don't know, they are not willing to sell their houses. The demand is low, and this is what happens. Price is only down 5%, while on the other hand, new homes are down.
Can I ask you both a question, Marko? I want to ask you both this question because this just popped into my head now, and I have no idea if this could be right or not.
And is a question about a white T-shirt being appropriate to wear anywhere? Is that what the question's about, or no?
When you're Italian, a white T-shirt is appropriate.
I thought it was a black T-shirt is what you want. No?
No. Well, yeah, that's when you want to dress up.
Oh, yeah, okay. Good.
Yeah, but in a normal setting, a white T-shirt.
It's perfect. I agree with you, actually.
Yeah. Jeez. It's like we just met or something.
What's the question?
No, my question would be, so obviously when people get out of an existing home they're in and they go into a new home, let's say, and I'm making this stat up, 75% of the time they're upgrading, right? It's not because they lost their job. It's because they're upgrading. Either their family grew or their wealth grew and they want a nicer place. It's one of those two things. And obviously the leap is a lot greater when you have 8% or 7% rates, mortgage rates versus 2.5 or 3, right? The leap's bigger. Number one, how far do they have to fall in order for that to pick up? And number two, are home prices sort of artificially staying higher because the leap in rates is just too high for the current people to drop their homes without job losses?
Can I answer that first?
Yeah, go, Jimmy, and then give it to Marko.
The answer to that is absolutely 100% yes, that there are just tons of people who won't sell. because they can't jump up to the next level because they can't afford the mortgage payments.
So
My
they can't
daughter
drop
looked
the price, right?
Right, and they can't drop the price. And so my daughter looked at a place last night, it was $550. In 2 years ago, she could have afforded that easily. And she told me just now, I just priced it out, the mortgage payment is too much. That's amazing to me. She does very, very well. So yeah, I think it's absolutely that. I think and I wrote a piece on that I'm going to put out tomorrow, and I'll send it to you, Bobby, too, about the level. 19% of loans right now are under 3% of mortgages. In 2019, 1% was under 3%. So everybody had the chance to roll in duration. Right now, 60% of loans are under 4%. In 2019, 37% of loans were under 4%. Everybody, so they raised rates, but they didn't change the effective mortgage rate. I think the effective mortgage rate that people are paying is 3.8% is the average that people are paying. It's an absolute clusterfuck what happened in raising rates. The way they did it, how quickly they did it. And to Marko's point from before, they keep doing it thinking, oh, we're not seeing any results yet. No, they're not going to see any results yet. They're not going to see any results for about a year and a half. And every month they'd be like, shit, we're not seeing any results yet. Better do it again. So this whole thing is a complete cluster. Marko, sorry. That was my high horse.
Yeah, I absolutely agree, because the only way this thing can change is actually if people lose their jobs, if they lose their income, and then actually
they have to sell their homes.
We will see. Yeah. Well, actually, you will just get foreclosures, and
sure.
then you will get more supply in the market, and the price would collapse in a similar manner that we've seen during the great financial crisis. But I think that this kind of behavior was never necessary for the Fed to achieve their goals. I think that they actually underestimated the effect of rate hikes on the economy, and they are actually trying to see the results right now. They are just looking for these results, and results are not going to come maybe for another year, at least not to the extent that they are actually expecting. And when they start coming,
I think we disagree on something. I do think at the beginning they should have raised rates maybe 150, 200 basis points at the beginning, just to let people know that easy money times were over for now, but then waited to see what the effects had. You don't think they should have just left rates where they were, right?
Of course I don't, because
okay. I think
yeah. No. I think they should have raised rates to neutral. If they see neutral at 2.5%, then this is probably somewhere where they should have kept this Fed funds rate. There was never any necessity for the Fed funds rate to go into what they call restrictive territory, because actually at that time it was evident that there was there were no additional inflationary pressures during the summer of 2022, when you looked at all of the data, the goods inflation, actually goods prices, for example, if you were following, you can see it in, for example, S&P GSCI index or whatever. If you just look at the commodity prices, you would see that commodity prices were going up until I don't know, it was June, the 8th of June or something, and then they collapsed. And Fed had their meeting on, I don't remember now exactly, but it was probably June the 13th or something. And then at that meeting, they decided, okay, now is the time that we are going to raise rates by 75 basis points. So actually, after they did it after the all of commodity prices already started to pull back, and this was okay. So now after inflation actually stopped being a worry as it was prior to that, and then they were like, okay, now we are just going to show that we are on top of the things, and we are just going to show everyone we mean it, and we are going to overdo it. Actually, when they waited for so long to start hiking rates, they got into this. I don't know. It was kind of they were unsure whether all of their actions had any impact on their credibility. They were always full of it that their credibility was that all of these actions impacted their credibility. And I was like, okay, but your credibility has always been like, I mean, people in the market are expecting the Fed not to be right when they are doing hikes and cuts, because this is like a normal thing. The Fed rarely is on top of things. Like it's usually behind the curve. It's
usually, I'll say always.
Yeah, maybe.
Well, because their tools are all so backward looking. I know we've hit that point quite hard right now, but their tools are so backward looking they can't ever possibly land on the right thing. It's just psychology. They'll keep raising until they see the effects, which meant they had the right rate a year ago when they start to see the effects. So it's a whole bunch of bullshit thing. Bobby, though, you got something?
Yeah, actually, we're slowly running out of time here, Marko, but I wanted to ask you from a perspective of equities, what do you think is in store for equities then? And tie that up to what you think about the Fed, because if I'm hearing it right, the Fed's never going to do anything right. And whether we think they should do things or not, they're going to do it their way. So given that, do you think the market's right about pricing in 100 basis points for next year of cuts? Or do you think that they'll mess it up again and equities will suffer? What's your sort of overall view on all that?
Well, actually, I think that the market is hoping for the Fed to only cut by 100% by 100 basis points next year. But the risk here is that they actually cut by a lot more, because in the same manner that they were late to hike in 2021, they will be late to cut. And if they are late to cut, you can just look at things just for them to return back to neutral. If neutral is at 2 to 2.5%, they would need to cut by 300 basis points. This is a whole lot more than the market is expecting at this point. And if that happens, the market is not prepared for any such scenario. Of course, they will probably not cut by that amount unless the economy is really tanking.
Can I underscore that point you just made, because I think it was brilliant. For people who may have lost it. So what Marko's saying, the neutral rate, he said between 2 and 2.5%. I personally think it could be a little higher than that, but that's dicing too thin, whatever. So what he's saying is that when the need arises to cut, well, why wouldn't they cut right back down to the neutral rate, whatever it is? Because we'd be in a too restrictive a time period. That's what you're saying, right?
Yeah.
Okay.
Because they will likely, if they see like, I don't know, unemployment going up, non-farm payrolls, negative month. I mean, 1 month of negative non-farm payrolls would be enough for them to get scared, because that would mean, okay, we've done too much. We are going to cut now. So actually, if they would just want to return to neutral, they would need to cut by 300 basis points,
right.
And that's a lot. That's not like The market is like.
Oh, you go. Yeah. Oh, I'm sorry. I was going to say we covered a lot of ground. I think it was so awesome to have you here, Marko. I really think tell the people where they can find you again. I want them to make sure they follow you on Twitter because you put out a lot of good stuff and it's written cleanly. Tell them where to find you.
Yeah, they can find me on Twitter, of course, at Bjegovic. This is my.
So you expect everybody to just know how to spell Bjegovic. You're not going to spell it out because like it's such a simple name.
Yeah,
like
maybe,
Smith,
maybe.
Right?
Yeah.
I'll spell it out then. At
Yeah.
MBJEGOVIC. Marko Bjegovic, founder and CEO of Arkomina. And by the way, my last name is Yurio and Bobby's is Iachino. So we have had plenty of experience with difficult names for people to pronounce. But thank you so much for being here. We have to go by because we're running out of some time. But thank you so much. I hope to talk to you again.
Thank
Okay,
you,
Marko?
guys.
Thank you, Marko.
Yeah,
We'll talk to you again.
definitely.
So
Yeah.
Jim, given what